Bazaar Morning Call. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studio, starting a fresh new week, Monday morning, 8 a.m. I'm Prashant. With me, as always, my colleagues Sonia and Nigel. Morning, guys.
Hi,
morning.
Good morning, Prashant. Morning, Nigel. Well, a start of a brand new week, but there are still some roadblocks, some hurdles that, the street has to sort of reckon with before those all-time highs come through. It's been a bit of a waiting game, I guess.
I want to start with what happened last Friday evening, when I don't think any of us was in office, but the team was, and what a Friday it turned out to be, right? One after the other. I mean, it just was
with the
flurry of
2,000 rupee
announcements.
note.
Yeah, the 2,000 rupee note, the clarification on the TCS. I mean, so a lot of stuff. And I think that 2,000 rupee note is something which we will take forward in discussions today in terms of the impact, etc. But I just want to quickly start with, just a few things that we always get to you, what you need to know as we begin another session. And I want to divide this into three parts. One is the market setup, how things are looking. The second is the 2,000 rupee impact. And the third is, of course, the global setup. So Nifty and the market setup first. Now, on Friday, we got a very nice bounce. From the lows of the day, we got a 100-point bounce off the Nifty's low. We touched the 20-day moving average, took support. Actually, intraday, we did break the 20-day moving average. But basically, you got a clean bounce off that and a very nice, decent close. And, since the 12th or so of May, which is over the last prior 1 week or so, the market has basically been coming off. All right, we got a higher close, but for the week, the Nifty was down 0.6%. So there was a bit of a congestion zone. And with this kind of a bounce, an important short-term reversal level, the question is whether we can move higher. Now, for that to happen, Friday's low becomes important. 18,060 should not be broken if we are to get a bounce which kind of sustains from here. The 20-day, of course, will come into reckoning again. But the low was under the 20-day, so I'm putting 18,060, the low as the critical point. The high on the Nifty at 18,459, this is the high which was made on the 15th of May, can be retested. I would say it's more bullish as compared to bearish. That's basically my thought process at this point in time. There are some sort of conditional aspects which we will get to in just a bit from now, but a test of an important sort of level and then a clean bounce. It's not looking bad. Now, the Bank Nifty support comes in as 43,466, and then at the 20-day moving average, which is 43,300. Now, the 43,466 is Wednesday's low, I think, and then the 20-day moving average. These are supports. Bank Nifty needs to break out of the congestion zone, and the congestion zone high is basically 44,150, which is also pretty much the all-time high. About 2 points or so higher than that is the all-time high. So this is how we would look at things. Now, coming to the 2,000 rupee note withdrawal, and there'll be lots of opinion which we will get to you, but announcement came Friday after market hours, Friday evening. Now, the important thing is, unlike the 2016 demonetization, the 2,000 rupee notes at this point are only about 11% of total currency in circulation. At that point, the total amount of money which was demonetized was almost 86-87% of the currency in circulation, so this is not that large. Which essentially also then means that, the impact, the near-term economic impact overall could be quite limited. That's the understanding. Now, some are saying that this is great news for banks because as people go and return the money and give it to banks, and banks in turn give it to the RBI, it swells deposits, brings down the cost of deposits for banks. It sort of takes care of the liquidity in the system, etc. But the point is that will depend on how much is going back and how much is being exchanged, which we don't know. People like Citi's India economists are saying that they expect only about 10 to 15% of these notes to actually be deposited. So the impact even on that, on the overall deposits in the system could be limited. But this is a point which we will come to a little later, but overall impact is limited. Now, global markets are the other third point. They are beginning to price in a 25 basis point hike in the month of June, in the next Fed meeting. US data is the number one reason. Retail solid sales, the initial jobless claims dropped, so things are not looking all that bad. The important sort of near-term mover, and this could be big, is the debt ceiling. Now, by all indication, there is no official date given for when the US Treasury runs out of money, but there are estimates, and best estimates converge around the 1st of June, which means that the markets will wait for some kind of a deal to be reached this week over the next 5 trading sessions. It always happens. It does go through. Sometimes it's last minute, sometimes it's a few days before, but so far we've had scares, but never has the Treasury defaulted. So markets are assuming that it'll get done this week, and I think, but markets will wait. I mean, it's not done till it's done, as they say, and I think once it's done, markets perhaps will see relief, and perhaps we see a bit of a risk on in global markets as well. So that's the only near-term kind of thing which global markets will hold on and watch at this point in time. Otherwise, I mean, the economy in the US is looking better as compared to what was perceived a month or 2 months back. SGX is up on your screen. It's indicating a 25-point lower start. Sonia.
Oh, absolutely. And, we're going to start on the back foot today, not just because the SGX Nifty is under pressure. Global markets have been under pressure. The Dow had, a big fall as well overnight on Friday. And even for our own markets, right? I mean, the Nifty closed lower by 1% last week and is facing resistance at the higher levels, 18,400, which was the high we hit on Monday, around 18,450. Since we hit that high, the market has just cooled off from there, so come off quite a bit. There is this negotiations on the debt ceiling talks which continue, and that has kept a lid on the global market gains. For our own markets, it's an important week because we have the F&O expiry this week, so all eyes will be on that. If you look at the global markets, there was, of course, pressure that we saw on Friday, but this is what the weekly performance has been. It was a pretty strong session that we saw. 3% higher for the Nasdaq, S&P 500 up 1.5%, and even, a lot of markets like Japan have been doing pretty well. So let's see how our own markets move forth. The one interesting thing is after 16 days of buying, finally we saw a sell figure from FII. So FII flows have cooled off a little bit. Perhaps because, resistance is kicking in also at higher levels. But this is the last leg of the earnings season. So let's see what we get in terms of takeaways from there. There are a lot of big numbers. There's Hindalco, M&M, Sun Pharma, Ashok Leyland all coming out with numbers this week. BPCL as well. So a lot of the interesting pockets report their earnings. And I just wanted to put one view that came in from Surendra Goyal of Citi this morning, where he has actually raised the Nifty target to 19,400 by March of 2024. And that's a 6% upside to Citi's earlier target. Now, the reason they state is that the Indian market valuations are now becoming reasonable compared to the last 5-year average. So it's just a valuation game that they're looking at. They say that FI flows have picked up. Domestic mutual fund flows are resilient. The market is likely to re-rate higher. So there continues to be a lot of bullish calls on the market, although we are facing a bit of a hurdle on the upside. Just one thing, on the 2,000 rupee note cleanup, I mean, from a viewer or an investor point of view, one thing, it continues to be legal tender.
Yeah.
And you can exchange up to 20,000 rupees at one time. It is, a free of cost exchange. So there is no need, I'm sure a lot of people know this, but there's no need to panic at all. It is very different from the demonetization situation that we had last time around. And it could ease short-term rates as well. So, in my understanding, I don't think it is such a big deal. But then, of course, experts may suggest otherwise.
No, you're absolutely right, Sonia. I mean, no need to panic, and I think we should say that unambiguously. Yeah. And the impact also seems to be much smaller because it's a smaller portion of the total currency in circulation. But Nigel, what are you watching on for?
Well, the FI net sell number, is it a change of trend or was it just a flash in the pan? We'll know today, right? And as you said, the dollar index is a little bit weaker, which is good. So hopefully that was just a flash in the pan. The Nifty buy zone, well, we have that 18,050 to around 18,100. And this RBI withdrawal of the 2,000 rupee note from circulation, well, it could be beneficial to banks and maybe some discretionary sectors as well, just in the near term. But I'll be interested to see what's the reaction in broader market stocks, particularly some small cap, mid and small caps, or some cash market stocks. So let's see how that goes. What do the FIs do? Well, they added some mild short positions. Short positioning now is at around 52%. On the index option side, they bought more puts than calls. So in case things go wrong, you have some cushion out there. But what's encouraging, what's telling you maybe that 18,000, 18,050 will still hold out. Remember, it's expiry week, is the way they're writing puts. So they still wrote more puts than calls. Giving a broad sense about the options data, the highest open interest is at around the 18,200 call. So at higher levels, you're expecting that level of around 18,250, 18,300 to be met with some resistance. As we've seen in the past, 18,300, well, that'll be a mark that the bears will be looking to defend. But the encouraging part is there's writing witness at around 18,000 put as well as the 18,100 put. So it brings us to the levels. What do we look out for? Friday is low. That becomes an important support out there. You have the 20 DMA as well. So that's why I said 18,050 to around 18,100 becomes important on the downside. The Nifty Bank. Well, Friday's low again becomes important out there, 43,500 approximately. From there, we saw a bit of a bounce. If you break that, then you're hoping that at least that 43,300 odd mark holds out, because that's the 20 DMA. But on the upside, the fresh 52-week high, can we get past that level? Positioning is such that we don't get past that. If we can trade above those levels, I'll tell you what, the Nifty Bank will lead the Nifty higher, and that could easily play out given that we have expiry week. SGX Nifty suggesting a bit of a pullback. The buy zone, though, is a little bit deeper, so let's see how this goes. But today, I'll have an eye out on the broader markets to see if there is some incremental selling that comes in, particularly on some of these cash market stocks.
Okay, well, before we start, let's just tell you what's lined up in the first half hour of the show. We will be getting you updates from the markets across the globe. James Sullivan of JP Morgan will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC TV 18's list of top 10 stocks for the day. At around 8:30 a.m., we'll do a fundamental stock analysis with our market expert, Prakash Diwan. So do stay tuned in for that. But first up, we have a couple of interesting views coming in on the market. So let's take a look at that. First up, we have a call from Sridhar Shivaram of Enam Holdings, who said, this is a sideways market, and they expect the market to be range bound and interest rates to be higher for longer. They do not expect the RBI to cut rates at least for the next 6 months, which according to Enam is not the best environment for equities. In terms of earnings, Sivaram expects Q3 and Q4 to be better for discretionary and consumption companies.
Okay, well, let's get you some money market views. On the rupee, B. Prasanna of ICICI Bank says better economic data prints, uncertainty over debt ceiling deal and hawkish commentary by Fed members kept dollar on strong footing along with rising yields. Weaker than expected data flow from China is putting pressure on the yuan and the entire Asian pack. Rupee, even though supported by good external balances and flows, fell on position squaring in offshore market owing to shrinking carry and stronger dollar against Asian currencies. In the near term, they expect rupee to trade between 82.4 to 83.2 to a dollar, with RBI selling dollars to protect sharp INR depreciation.
And on the bonds, B. Prasanna of ICICI Bank says global yields inched higher even as local bonds initially rallied on expectations of a very high dividend from the RBI. The actual dividend announcement on Friday fell short of expectations, and as a result, bonds gave away all the gains. Additionally, the RBI announcement of phasing out of 2,000 rupee currency notes is expected to result in an increase in the partial system liquidity over the next 3 to 4 months. This, coupled with large GSEC maturity, augurs well for the short end of the curve. He expects the 10-year benchmark to trade in a range of 6.9 to 7.05%.
Well, we have a lot of stock-specific action which we're tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at JSW Steel, NTPC, Power Grid Corporation, Muthoot Finance, Bandhan Bank, Bharat Electronics, Zomato. Their stocks on the back of positive news flow. While on the flip side, you have Divi's, Glenmark, Delivery. Their stocks that could be reacting to negative news flow.
Okay, well, I just want to put out one more view. This is coming in from Goldman Sachs' economist, and this is a view coming in the U.S. Debt ceiling crisis. Now, they say, and I quote, the U.S. Treasury has indicated that it is likely to be unable to make payments by early June without an increase in the debt limit, with the risk that this should occur as soon as the 1st of June. Overall, most parts, they say, of financial markets appear relatively sanguine regarding the approaching debt limit deadline. While they expect a deal to occur ahead of the deadline, they also expect a few more twists along the way and suspect that markets are likely to price in additional risks before the debt limit is finally raised. But raised it will be, they say, in their base case.